We now have this pandemic, and we have, on the one hand, the economy being opened up, on the other hand, the economy being closed down.
Confidence is rising in the United Kingdom. Europe has done a very good job in catching up.
The reality is what we've got to avoid is any form of technological control of our electronic infrastructure.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 27th of July. I'm Danny Berger in London. Here's what's coming up on today's program. Hong Kong issues its first guilty verdict under its security law. The HSI sinks more than 5% and Tencent tanks by the most in 10 years. ARK's Cathie Wood dumps Chinese stocks as Beijing's crackdown on private business also weighs on equities. Markets fall for a third day. And a Tesla milestone. The electric car maker tops $1 billion of net profit for the first time in its 18-year history, beating 97% of analysts' estimates. Well, beyond that, it's certainly a dour day in markets, really emanating from what's happening in China and Hong Kong, with a Hong Kong court issuing its first guilty verdict under the security law imposed by Beijing. Tong Young Kit was found guilty of a charge of incitement to secession and another of engaging in terrorist activities. The waiter, who's been held without bail for almost a year, pleaded not guilty over his actions at a protest in 2020. That's when he drove a motorcycle into a group of police officers. Now, the charges brought under this law, also in the wake of the 2019 protest, could carry a maximum sentence of life in prison. Now, we certainly saw a market reaction to this headline, along with everything else that's going on China. So let's get into the market impact with our Juliet Sally. Jules, you've been looking at the data, you've been looking at the markets. That headline over the security law, what sort of impact and how did that play out in the broader markets in China?
Yeah, Danny, we've seen a huge leg lower coming through in the Hang Seng Index in the last half hour or so of trade as we round out this session where you've got the Hang Seng Index once again plummeting by 1,000 points for a second session in a row, dropping the most since May last year and holding now at November lows. Part of this as well, though, due to the broader clampdown we've been seeing from Beijing, and it could also be due to a lot of traders just winding out margin calls as we get towards the latter part of trade as well. But it has been a huge day of selling coming through in a number of these key indexes. And of course, you've seen that flow through into other parts of the market as well. So not just on the Hang Seng Index, we've been seeing money going into the dollar, the offshore yuan actually now holding at April lows, and also some weakness coming through as well in the broader CSI 300, Danny.
Yeah, you mentioned that broader tech clampdown. What are we seeing in markets there? David Ingles pointing out that it's the HS Tech's first birthday. What a depressing birthday it's having, Jules.
Yeah. Indeed, it is the anniversary there of the Hang Seng Tech Index. We're now seeing what I was talking about in terms of both the on and offshore yuan there, significantly lower against the dollar. Let's have a look, though, at that Hang Seng Tech Index because it has been this broader tech clampdown. We've been talking about MEITUAN falling by as much as 16.6% today, the most on record. Tencent in the crossfires as well. It's been falling the most, as you mentioned, in a decade. And we can now see this Hang Seng Tech Index in negative territory 1 year after its inception. So it was supposed to be this index that saw investors get into the 30 biggest tech companies listed in Hong Kong. It had that huge peak coming through in February, but since then, a drawdown of about 45% as we now see this index basically reverse all the losses that it's had since its inception. There's still a lot of buyers, though, in a lot of these players. You've had Jefferies saying that MEITUAN, for example, they still see as a buy. They've got a price target of 400 Hong Kong dollars. It's trading below 200 at the moment. But a lot of others, Danny, saying, look, it's not really a time to bottom fish just yet. They're still seeing some more headwinds ahead, including Daniel So from CMB International. Danny.
So no time to buy the dip yet. Juliet Sally, thank you so much. And let's get more into this. We're joined now by Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets. Elsa, thanks so much for joining us this morning. So yesterday, when we initially heard more about China cracking down on ed tech, there wasn't really much move in these markets in China besides stocks. But now we are starting to see a bond market reaction. We're starting to see the yuan head lower, weakening against the dollar. Does it make sense to you that this would have cross-asset ramifications and that the yuan, the renminbi, would go lower from here?
I think it's the fact that you're seeing this spread a little bit more broadly. So what started as a crackdown on the education sector is now being interpreted as potentially something a bit deeper. And in addition to that, that generates market chatter, completely unsubstantiated, may or may not be correct. So I would need to lie on air, but those kind of situations create a bit of a rumour mill. And a few of the stories that have been going around this morning have people a lot more worried about capital flows surrounding those stocks. And that has a knock-on effect in foreign exchange. So, we're seeing the kind of classic risk-off hallmarks this morning, just since the Chinese market closed. Whether that lasts, though, I think is much harder to say. We've seen it with previous drawdowns, which tend to be pretty short-lived because just with the amount of liquidity that's out there in the system, we would keep looking for opportunities to get back in.
Right, and of course that liquidity, it's so present in all of these markets and providing a floor. But to play devil's advocate, Elsa, could we see a situation where China's crackdown on some of the more capitalistic tendencies of the market spill over into a more of a macroeconomic effect that, again, makes these markets unattractive to hang out in?
I wouldn't be so concerned about the macroeconomic effect, but more around the attractiveness for an institutional investor who will prize, institutional certainty, knowing what the rules are, and therefore being able to draw their own conclusions as to the investability of a particular name. If I bring it back to foreign exchange, we are seeing a little bit of spillover in the renminbi, but it's relatively limited. I mean, the renminbi still is trading relatively close to the highs. So, for all the impact we've seen this morning, it's too soon to say that it's turning into a broader macroeconomic story. It's very, very far from that.
Right. And yeah, that's a very important point. I mean, we're seeing Hong Kong stocks down pretty dramatically, but as you say, renminbi only weaker against the dollar by about less than 0.5% versus the U.S. dollar. Elsa, you're going to stick with us. We have more to cover. That's Elsa Lignos from RBC Capital Markets who's sticking around. Now, coming up, we dig into the tech story and Tesla, which topped profit forecast. It passed $1 billion in net income for the first time in its 18-year history. But first, up next, U.S. real yields sending a warning on growth ahead of the Fed's July meeting. We discuss the outlook with Elsa. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get over to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. New York City and California are to require government workers to get a vaccine or submit to weekly coronavirus tests and wear masks indoors as cases linked to the Delta variant climb across the U.S. New York staff have until mid-September to be vaccinated. Those who resist the new rules risk dismissal without pay. Meanwhile, the CDC says Americans should avoid travel to Spain due to very high levels of COVID-19. Workplaces here in the City of London were the busiest they've been for 16 months last week. But despite the lifting of government restrictions, there was only a marginal increase in attendance on the previous week. According to data compiled by Google, just under half of workers were back in London's offices. The US and China have left open the possibility of a presidential summit despite contentious talks between top diplomats. The White House says Deputy Secretary of State Wendy Sherman's visit to Tianjin was focused on setting guardrails on the relationship. She was presented with 2 lists of key demands by Vice Foreign Minister Xi Feng. In return, she underscored US concerns but said Washington doesn't seek a conflict with China. And China didn't finance any coal projects via its Belt and Road initiative in the first half of this year. The first time that's happened since the plan was launched back in 2013. According to the International Institute of Green Finance, more than 70% of all coal plants built today rely on Chinese funding, followed by investment from Japan and South Korea. Belt and Road funding for green projects was also hit during the pandemic. Global news. news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm LEIGH-ANN GERRANS. This is Bloomberg. Danny.
Leanne, thank you so very much. Now let's turn to the U.S. and the Fed, where investors are gearing up for tomorrow's Fed decision, where the pace of central bank's bond buying program will be in focus for everybody from economists to traders. And according to economists surveyed by Bloomberg, the Fed will start pairing purchases from next year. Officials will probably also discuss how the balance of the downside risk from the Delta variant with upside risk to inflation. So that's the balance that they're looking at. Now, Elsa Lignos from RBC Capital Markets is still with us. Elsa, ahead of the Fed decision, we're looking at an absolute plummet in U.S. 10-year real yields at their lowest level on record. What does that tell you? What does the deeply negative value of a U.S. 10-year real yield tell you?
So I think there are a couple of things to bear in mind. The first, which our U.S. rates traders have mentioned quite a few times, is that, Treasury markets are global markets. And the fact is that if you have growth fears or slowdowns, shutdowns in other economies, then you see a bid for U.S. bonds as a result of that. Alongside of that, you just have general presence of liquidity in the system that we were referring to earlier. But I think the underlying data flow in the U.S. has been very positive. It's certainly likely to peak in Q2, but to come down to a still elevated level. And that, for me, reinforces the idea that U.S. rates may well end the year a bit higher in yield terms. It's just going to be a slow and long process to get there.
Yeah, I mean, how does that translate into your dollar view? Because one of the more remarkable things we've seen is that investor positioning on the dollar, that very bearish view to start the year, has more or less evaporated. If you dive into the charts and look at the CFTC data on the dollar, you see that that's flipped from net short to net long. How have you adjusted your dollar view in the past few months in the face of a stronger dollar? Do you fade this move?
Well, for us, it's been pretty nice, actually, because we started out with a positive dollar view in the beginning of the year. And obviously, the first quarter went pretty well for us. The second quarter was a bit more painful up until the June FOMC. So I haven't changed anything in terms of my forecast. And we've moved a long way towards reaching those levels I had in mind. But I'm not tempted to change them further, because I think the underlying cyclical story is still very much intact. The U.S. is ahead of most of the rest of G10. The Fed is not going to hike anytime soon, but it will hike well ahead of the ECB and the SMB and the Bank of Japan and possibly a couple of others. So that, for me, means that the dollar can be a cyclical outperformer.
All right, Elsa, a nice prescient move from you from the start of the year. I love that. And another one of your calls that stuck out to me is a more of a short-term call you have. You have your trade of the week being to short the euro versus sterling. Why have you put that move on?
So it's something that, like you said, is a very short-term tactical move. We were looking at the turn in the data on COVID in both England and Scotland. We think it's very much down to a football effect, so it may well not last. But we have seen more interest to sell euro sterling and look for another test of that 85 level. And so, like I said, on a tactical horizon, we're looking for a break of that to take us down into the 84 handle.
So the football effect there, of course, during the Euros, more cases, but we have seen UK cases drop for 6 consecutive days. Does the breaking of that link between cases and hospitalizations, what does that mean for your longer-term view when it comes to sterling?
So that break between cases and hospitalizations, not just for the UK, but for every country with a high vaccination rate. And I think that's really what keeps us a lot more sanguine on prospects for the global recovery continuing and reopening continuing. I think that the biggest fear that everybody has at the moment is what happens if you get a new variant, higher vaccine evasion potential. As far as the UK is concerned, I'd come back to some more structural issues, and we have them bubbling away in the background, a lot of tension over the Northern Ireland Protocol. I do think the Bank of England is a little bit overpriced by markets, and so I certainly wouldn't want to be long sterling.
Right. And so So, Elsa, you mentioned that you still have these fears bubbling in the background of the Delta variant. Given those fears, do you want to hide out in the yen, for example? Where are you hedging with that potential tail risk?
I think a different way to look at it, and one which has actually worked quite well for us for the last 5 months, is you can still be long high domestic currencies, for example. You know, we like the Mexican.
Elsa, I'm sorry, you're going to have to hold that thought. Unfortunately, I think your line is sounding a little bit sketchy, but Elsa, you're going to have to come back and join us when we can figure out some of those technical issues, the glory of 2021 and some of those phone difficulties. But Elsa, thank you so much for joining us. That's Elsa Lignos, Global Head of FX Strategy at RBC Capital Markets. Now, coming up, despite topping analysts' profit forecast, Tesla CEO Elon Musk warns on the global chip shortage, something that's been plaguing car maker after car maker. We're going to have more on that next. This is Bloomberg.
Regarding the chips, we're pretty good because we bought ahead for the near term. Longer term, I think the problem will go away. But for medium-term planning, at the beginning of next year, we have risk mitigation strategy, including alternative sourcing for some chips and alternative PCB designs to accommodate those. I think we're in a good position. We have a number of backup plans in place.
Is out of our control, essentially. It does seem like it's getting better, but it's hard to predict.
Those are the CEOs of electric vehicle manufacturers, both Lucid and Tesla, Peter Rawlinson and Elon Musk, on the chip shortage facing the industry. Now, it was a big day when it came to EV makers, and Tesla beat earnings expectations with its second quarter numbers. It topped $1 billion in net income. For more, we're joined by Bloomberg's Benedict Hamel. So, Benny, beats on expectations, beats on profit, but I'm looking at a pre-market trade right now. It's only up a little bit more than 1.25%. So what was the big takeaway? How exactly did Tesla fare in this reporting season?
Good morning. So, yeah, the numbers were very strong here. Really, every way you look at it, that $1 billion profit that they had, which is really a blowout figure, particularly for a company that a couple of years ago was really sort of trying to make ends meet, and things were looking much harder for them. The cash flow is up. The margin is very strong. From the core auto manufacturing, the margin is above 25%, and that is more than twice what companies like Daimler deliver. So really strong set of numbers. But as you say, the stock not really reacting that much. There was a lot to digest there. There was the numbers, but then obviously the outlook, and that's where things got a little bit more touch and go. We have a lot of issues, and Musk talked about those. Yeah.
Betty, can you get into some of those issues? What are the key challenges for Tesla?
Yeah, so a couple of challenges. One that really resonates across the industry is the shortage in chips that we've seen for a couple of quarters now. He said, and we just heard it in that little clip, that makes forward planning unpredictable, very difficult. They might need to think about coming up with new chips, reallocating some production and so on. That's one issue. Rising commodity prices is another issue. And then obviously the competition, because the likes of Volkswagen, the likes of BMW and Daimler and so on, they're not standing still. They're pumping a lot of money into the whole EV space. So over time, we will see them catch up, and it'll be interesting to see how that sort of first mover advantage that Tesla's had for a long time, how that plays out.
Yeah, definitely a lot of risks, it seems like, are on the horizon for Tesla. So what's next? What can we expect to come from the EV maker?
Well, we will see that new plant go up in Berlin. They're building it at the moment, and we will see the Model Y roll off the Model 3. We'll see some new models coming out. And more interestingly, and that was almost one of the sort of key takeaways from the call, was Elon Musk seems to be taking a bit of a step back. He said on the call yesterday that on future earning calls, he might not actually be there. Does this tell us that in some ways he's sort of taking on a more mature role, that he feels that with that $1 billion out there, he feels he can sort of let the company do its own thing. He doesn't have to sort of have every finger in every pie. So that was an interesting sort of little nugget that came away from this is, are we seeing the next phase of Tesla and Musk, and he's actually looking at other things and letting the company sort of putting a bit of space between himself and the company. And that was an interesting takeaway. Our colleagues in Opinion have a good piece on that out today, so just flagging that for everyone's reading pleasure.
Right. And I also love in that story, he talks about not having time to do YouTube interviews as well, which, of course, he had done a fair amount of previously. Benedict Campbell, thanks so much for joining us and giving us the latest on Tesla. Just a quick look at where Chinese markets are. Definitely seeing some stress there, a stronger dollar versus a yuan. We're also seeing the Hang Seng drop by more than 4%. We're going to stick with that up next. A Hong Kong court issuing its first guilty verdict under the security law imposed by Beijing. We're live from the city of Hong Kong. Up next, as we continue to see that market weakness. This is Bloomberg. Hong Kong issues its first guilty verdict under its security law. The HSI sinks more than 5% and Tencent takes by the most in 10 years. ARK's Kathy Wood dumps Chinese stocks as Beijing's crackdown on private business also weighs on equities. Markets fall for a third day. And a Tesla milestone, the electric car maker tops $1 billion of net profit for the first time in its 18-year history, beating 97% of analyst estimates. Good morning. I'm Danny Berger in London, and welcome to Bloomberg Surveillance Early Edition. On this dour day in markets, really setting the tone are the news flow coming out of Hong Kong and China, where a Hong Kong court has issued its first guilty verdict under the security law, the law imposed by Beijing, of course. Tong Yin Kit was found guilty of a charge of incitement to secession and another of engaging in terrorist activities. Now, the waiter, who's been held with almost a year without bail, pleaded not guilty over his actions at a protest in 2020 when he drove a motorcycle into a group of police officers. Bloomberg Chief Asia Economics Correspondent Enda Current joins us now from Hong Kong. So, Enda, what exactly are the consequences of these types of verdicts?
Well, we have to wait for the sentencing tomorrow, but this is a kind of case people are watching very closely for any evidence of an erosion of the rule of law in Hong Kong. Remember, one of the great appeals for Hong Kong as a global place to live and do business is the fact that it has the rule of law here, unlike, of course, mainland China. The concern is that that's being eroded given China's political takeover and overhaul in recent years. So people are closely watching these kind of national security cases. Now, of course, China pushes back against critics and say it's their own internal affairs. But there's no doubt there is a lot of eyes on whether or not Hong Kong's legal system can stand up during this period of stress.
And this is also coming at an already ugly day in markets, especially in tech. But what has been the market reaction to this? Are we seeing anything in particular that is fueling a sell-off in Chinese and Hong Kong assets?
Well, I'm not sure if it's necessarily coming from the security law case, but no doubt there's been a big sell-off ongoing today, and that is a result of the ongoing crackdown in China on various sectors. We've had the technology crackdown now, of course. We've had that move against those online education outlets, and it's been taken two ways. On the one hand, there's a huge degree of policy shock. From those who don't follow this closely, they didn't see such a sweeping and aggressive move coming, and there are question marks over how these kind of new regulatory oversight will be enforced and where does it end. On the other hand, there's a view that, take a longer view here, China is not going to choke its tech or innovation sector. In fact, what it wants to do is to boost this as a sector, and this latest crackdown on education is all about making bringing up children cheaper, and of course that will drive longer-term economic growth. So I think today people are just trying to nut out and understand what's happening with this regulatory crackdown, but there's no doubt it's certainly rifling through markets, and that's why we're seeing the sell-off that we are.
You know, and Shuli Ren from Bloomberg Opinion has a really interesting piece out basically saying that, okay, foreigners were surprised at this, but if you've been paying attention to what's happening in China, you perhaps were not. So if it's tech, if it's education tech, I mean, do we have any sense of what's next? What might be the next sector or industry to face some regulatory pressure?
Yeah, well, there's no doubt that some of this has been building for a while. I mean, China has been warning the education sector. Those who follow that sector closely have been saying this crackdown was coming. Likewise, the technology sector has been, there was a view it was growing too big, getting beyond the reach of the central government, so to speak. But at the same time, though, even saying that, it must be said there's still an aspect of shock to the suddenness of these regulatory moves and the breadth of it. And of course, all eyes will be now on the execution of it and whether that causes any more collateral damage. And to your question, whether or not it goes into new sectors.
Yeah, very interesting. I mean, certainly, as you say, a shock. The market reaction does seem to be one of a surprise. Enda, thank you so very much. That was Bloomberg Chief Asia Economics Correspondent Enda Current from Hong Kong. Now, let's move on to luxury, not unrelated to China, which, of course, has been a big buyer of luxury goods. And on that note, it's been a stellar quarter for LVMH, which beat analyst expectations. Sales have soared at the world's largest maker of luxury goods, shoppers splashing out on brands like Louis Vuitton and Christian Dior. Now, it comes as stocks in the sector have been among the best performers in Europe this year. Joining us now from Paris is Bloomberg's Kailey Leinz. So, Kailey, LVMH reporting earnings last night that beat expectations. What sort of reaction are we seeing today?
So clearly, we are seeing that consumers are spending their lockdown savings into luxury handbags and goods. They're hungry for shopping after the pandemic. You have like-for-like sales at LVMH up 84% in the second quarter. And if you look at the fashion and leather goods unit, revenues is up 120%. One analyst at Bernstein actually put it this way, saying it is the strongest first half update ever for LVMH. It's interesting because LVMH has always been seen as a bellwether for the luxury industry. It's not only fashion, it's also watches and jewelry. Remember, they bought Tiffany for this very long acquisition saga during the pandemic for $16 billion. Tiffany, which they said had a strong momentum in the US and in Asia during the second quarter. And finally, the wines and spirits unit have also performed pretty well because people have indulged with champagne such as Ruina or Dom Perignon, even when they were staying at home.
Yeah, people breaking out the Dom, maybe in excitement that the lockdowns are starting to lift. I mean, what impact have we had that, has that had on the luxury sector at this stage of the pandemic?
If you look at the luxury sector since the beginning of the year, clearly it's been outperforming most other sectors. Inside the index of 600, Eurostock 600 Consumer Products and Services Index, you have stocks like LVMH, but also Kering, Richemont, the owner of Cartier, or Burberry and Hermes, all surging since the beginning of the year. Most analysts actually remain bullish on the sector, even though some analysts at HSBC, for example, is saying that this striking performance of the luxury stocks could actually run out of steam quite soon. One thing that this has done for the luxury sector, for sure, is that it has prompted a lot of M&A activity. Of course, you've got the big headlines with Tiffany and LVMH, but also some smaller headlines with Richemont, for example, recently buying the leather handbags brand Delvaux in Belgium, but also a brand like Italian designer Zegna listing via a SPAC. That was a more than $3 billion deal. And LVMH also increasing stakes in Tod's, the Italian shoemaker, or in the streetwear label Off-White. And clearly, this could prompt more M&A activity in the future. In fact, some brands such as Tod's, Burberry, or even Salvatore Ferragamo could become takeover targets, with Kering, the main rival of LVMH, owner of Gucci, reporting tonight after market, considered as a potential acquirer, especially since they reduced their stake in Puma, giving them a lot of firepower to also do their own luxury shopping.
So lots of shoes, lots of champagne. We'll see whether those good trends continue, as you say, for Kering later today. Kailey, thank you so much. That's our Kailey Leinz in Paris. Now, coming up, we turn to other earnings, and it's been a big week for big tech. Microsoft, Apple, and Alphabet have earnings due out later today. We'll discuss with Hargreaves Lansdown's Sophie Lund-YATES next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get over to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. MEITUAN has shed more than $60 billion of market value over 2 wild trading sessions after Beijing unveiled sweeping reforms against private sector companies. The world's biggest food delivery company, backed by Tencent, is already the target of a Chinese antitrust probe. Losses deepened after Beijing posted rules ordering online food platforms to ensure their workers earn at least the local minimum wage. Now, Tesla has lifted its delivery outlook this year after reporting a second quarter earnings beat. The EV maker posted a record profit of $1.1 billion, with operating income surging on higher sales of the mass market Y and Model 3 sedans. Tesla flagged a Bitcoin-related impairment of $23 million after the cryptocurrency's plunge in the second quarter. Bloomberg has learned that Credit Suisse has tapped David Wildermuth from Goldman Sachs to become its risk chief. The shakeup comes as the Swiss lender tries to move past its multi-billion-dollar Greensill and Archegos scandals. We are told the Goldman partner will succeed Laura Warner in the coming months. She stepped down as the firm lost about $5.5 billion from the collapse of Archegos. And BIONTECH plans to follow its successful COVID-19 vaccine with a jab to prevent malaria. In its first solo project, the German biotech company aims to start patient trials on the vaccine against the disease by the end of next year. Malaria kills some 400,000 people a year, most of them young children in Africa. And that's your Bloomberg Business Flash. Danny.
Leanne, thank you so much. Now let's turn to tech, where it is a big week for earnings. We'll get results from Apple, Alphabet, Microsoft, and chipmaker AMD later today. Now, tech shares, they've outperformed the broader market in the second quarter amid rising COVID-19 cases. That could fuel the stay-at-home trade further. But supply chain issues, rising U.S.-China tensions, and increasing scrutiny of tech companies could prove to be headwinds for the sector. Let's dive into this more, and we're joined by Sophie LUND-YATES, equity analyst at Hargreaves Lansdown. Sophie, thanks so much for joining us today. A busy day for tech, a busy day for you as well, I am sure. So Apple, one of the companies to report out of the gate. What are you expecting when we get their results for the quarter?
Hi, good morning. Yes, you're absolutely right. It's definitely not a quiet week on the tech earnings front. So looking at Apple, first of all, they really are potentially going to be a bit of a victim of their own success. When you look at the exceptional growth that they had, revenues of nearly 90 billion last quarter, that is expected to slow down quite dramatically. The extent of that is obviously what we'll be looking for, and how successfully they're keeping that upgrade cycle going.
Yeah, and in terms of that upgrade cycle, I mean, is there a fear here that we could be passing the peak in terms of earnings upgrades? I mean, this is, generally a thing that people talk about when it comes to broader earnings, but tech specifically in companies like Apple, could we be at the peak right now?
So it's a really big question. I mean, I know I personally, I'm part of the problem. I'm hanging on to an iPhone that I've had for years, because if you look at the gaps between each different model, it's kind of smaller than it was right in the beginning, when each new iPhone was, really revolutionary in its difference. And that is why, they're working really hard to keep everyone, to keep them spending their money on those new models. In terms of whether we're seeing the peak or not, I'm not sure. Apple's fans are kind of, dogmatically loyal. So I still think that there's room left for them to grow in that sense.
I have to say, I am right there with you, Sophie. I had one of the fingerprint iPhones for so long, like an embarrassingly long time. So yeah, I totally get that. Part of one of the risks, of course, here for Apple is the burgeoning tensions between the U.S. and China. What does it mean for these tech companies that rely a lot on the supply chains and manufacturing coming out of China? What are the concerns there?
If you'd asked me that question prior to the conditions we've seen over the last 18 months or so, I probably have been a bit more concerned. But if the pandemic has shown us anything, it is that these tech giants have just kind of, really unrivaled tools to deal with this kind of disruption. And if disruption does come down the pipeline, because the extent the disruption is unknown, frankly. We can see that they have the resources to deal with it. And even if there are blips on the journey, they tend to, at some point, come out of it in a pretty resilient shape still.
Okay, interesting. So we also got Alphabet today as well, Sophie. How high is the bar set now that we had already seen from Snap and Twitter and those advertising revenues really strong?
So I always say that a good way to think about Alphabet, or kind of Google specifically, is that it's the newspaper of the modern age, in that that's where everybody is doing their advertising. And so if we're looking at the others as the signs of maybe how Alphabet is going to do, I think that the read across is pretty positive. But as you say, with that means expectations are also pretty excitable, quite frothy right now. Expectations are quite high. But if any advertising business can pull it off, I'd say that was Alphabet.
Yeah, I mean, it is kind of remarkable because we're in this environment where it seems like people are taking safety into the tech stocks. I mean, is there a degree where it's almost like, okay, maybe we don't care that much about earnings in this environment because the greater macroeconomic environment draws people into these stocks?
There's certainly a great deal of excitement going on, and I think you are right. People are maybe not looking at the nitty-gritty of tech stocks in the same way as they would as something a bit less exciting. That does pose its own risks, but I think you're absolutely right. If you look at the technology that is being peddled by these guys, it's kind of on a cultural level, they're changing the game. So that does change the rules a little bit. And, the financials, they absolutely matter, but that macro environment is also worth, even more attention.
Sophie, you mentioned when it comes to China that, probably you thought it wouldn't be something that would be that impactful, before today. Well, I have another one that's kind of like that for you, and it's cryptocurrency and Amazon. Of course, there's been speculation around that with a new job posting, Amazon denying that this year they're going to have, be accepting Bitcoin or anything like that. But what would an Amazon flirtation with cryptocurrency mean for the company?
Sure, it's no surprise this is something that you want to talk about today. It's huge news. The market obviously had a huge reaction to that. And I think strategically, if you look at the build out of Amazon Web Services, a cryptocurrency would really kind of go hand in hand with what they're trying to do there. But in terms of what it actually means, the engine drivers of Amazon is very much still a retail operation. You look, what is it, about 108 billion, I believe, revenues were last quarter. So much of that comes from international retail. So a cryptocurrency, exciting prospect, definitely something we're keeping an eye on. But for what it means right now, the answer is it doesn't mean a lot.
Right. I mean, Amazon has trailed the broader market. Of course, a market mostly led by big tech here. Amazon up about 13% this year, S&P 500 18%. What would we need to see from Amazon to allow it to play catch up? Is there anything specifically that investors are waiting on?
The problem with Amazon is that they have had such a kind of continuous run of exceptional results that for them, they can post absolutely insane results, and the market just doesn't get as excited as it might do if one of the other tech names does it. It's kind of, they're expected to beat expectations now. So with Amazon, for them to play catch up in that respect, good isn't good enough. They would have to do something that was, completely beyond the realms of what the market was expecting.
Yeah, as you say, Sophie, a victim of their own success perhaps. Sophie, thank you so much for joining us today. Really important day for all things tech, and to have you on. Sophie Lund-YATES, equity analyst at Hargreaves Lansdowne. Thanks again for joining us. Now, an Amazon job advertisement, as we were talking about, fuels speculation and sends Bitcoin over $40,000. Sophie says maybe not important for the company now, but what does it mean for cryptocurrency? It dropped after the retailer denied the rumors. Up next, we talk all things crypto. This is Bloomberg. economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now turning to crypto, where Bitcoin tumbles below $37,000. That's after this Amazon job advertisement looking for a digital currency and Bitcoin strategist sent the biggest cryptocurrency over $40,000. But the posting fueled speculation about the online retailer possibly accepting the digital token in the future. Amazon has since denied it would do so this year. Joining us now is Bloomberg's Asia crypto czar, Joanna. So is this just sort of a buy the rumor type situation? Is that why we saw the price surge above 40,000?
Hi, Danny. So that would have been at least part of it. But there really was just this short squeeze on Monday morning in Asia. People came back after positive comments from Elon Musk and Cathie Wood towards the end of previous week, this Amazon news, and things just went higher quickly. And yesterday, almost $1 billion of crypto shorts were taken out in the 24 hours. So that was part of it. And then Amazon did fuel the last bit upward.
Yeah, that's a pretty significant short squeeze there. I mean, do we have any sense to whether that's now washed out of the market, whether that extreme positioning is gone, or are there other things that investors are going to be keeping their eye on going forward?
Some of it has washed out because people were saying there was a big buildup of those shorts, and of course now a lot of them are taken out. But Bitcoin is still really in this 30,000 to 40,000 range that it just hasn't been able to shake. And so we'll be watching to see, can it really break out one way or the other? Some people are saying there's still a big air gap if it goes down to 30,000. It could easily do that up quickly, down also quickly. But then if it can build momentum and keep working its way back upward again.
How have the other cryptocurrencies fared during all of this, Joanna?
Well, Ether's actually been about the same as Bitcoin. So it's up both of them are up about 20% in the past week, actually. And Ether is looking forward to an upgrade on August 4th. It's somewhat deflationary. Dogecoin has actually done pretty well also, but other cryptocurrencies have kind of underperformed those two. So it's been interesting. It's really kind of a Bitcoin Ether dominated move here.
I have to say, you mentioned Dogecoin. I feel like Francine's going to be so sad she wasn't here to talk about it because I know it's her favorite crypto above all cryptos. Joanna, thank you so much. That's Joanna Ossinger, our Asia crypto czar. Now, let's get a quick look on markets because they have been very negative considering the news emanating out of Asia. Now, rumors have started to swirl that potentially more foreign investors are selling off their Asian assets. That offloading of both China and Hong Kong assets certainly perhaps fueling that route. Maybe this is a sell the rumor if Bitcoin is buy the rumor. But within that, we're also seeing a more deeply negative U.S. 10-year real yield, perhaps stagflation vibes coming across from that. Now, that's it for this hour of Bloomberg Surveillance Early Edition. We continue in the next hour with Matt Miller and Kailey Leinz in New York joining me. This is Bloomberg.
Global investors. I think it should be a warning as well that even though China wants to keep the lines of investment open, there are risks involved.
I think that China is going to be a country with lots of uncertainty, lots of shocks, reform shocks, monetary fiscal policy shocks, all kinds of policy directional shocks.
We're on the verge of having platforms and companies that are so powerful and so influential in the political process that they're ungovernable. China has realized that this poses an existential threat.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, July 27th. Our top stories today: China's crackdown on tech stocks. After years of emulating Silicon Valley, Beijing is now charting its own course. Wall Street has its say. High-powered bank CEOs join other executives in urging Congress to pass that infrastructure package. Tesla reaches a milestone. For the first time, the electric car maker delivered $1 billion in net income. Now investors wait for Apple, Alphabet, and Microsoft to report after the close. I'm Danny Berger in London with Matt Miller and Kailey Leinz, both in New York. Francine Lacqua is off this week. And look, we have a lot of earnings on deck, Kailey, but it is a dour mood in markets, especially when it comes to tech in Asia. And Kailey, did you know that it is the first birthday of the Hang Seng Tech Index? I mean, this is such a depressing birthday. It's lost, what, like 10% of its value? That's no party to me.
Yeah, well, it's the Hang Seng Tech Index's party, Danny, and it'll cry if it wants to, and cry it did. As for what the benchmarks looked like in the Asian session, it was positive in Japan, but in China and Hong Kong, a very different picture. The CSI 300 down 3.5%, and the Hang Seng, the benchmark, down more than 4%. But as Danny was saying, that Hang Seng Tech Index off about 8% on the day after falling 6.5% yesterday. It is now negative over the last year since its launch. And of course, this isn't just about tech and education stocks. This sell-off in China has spread to the property sector, to the healthcare sector, and it is also hitting the food space after new rules were announced for online food. And that saw shares of MEITUAN down 18%, a record plunge after falling 14% yesterday. It's lost something like $60 billion in market value. Another stock to point to in the Asian session was China Evergrande, of course, the indebted property developer. A lot of concerns about its financial health lately, and it decided not to declare a special dividend. So the shares fell 13% on the back of that. And I would note the sell-off isn't just limited to equities. It also is hitting the Chinese yuan, which is weaker against the dollar by about 0.4%. Here in the U.S., despite the concerns in China, we did manage to eke out record highs yesterday, but finally risk appetite seems like it is waning this morning. S&P 500 futures down about 0.4% right now. You are seeing that bid for safety showing up in the bond market. We're down 4 basis points on the U.S. 10-year yield to sub 125. And of course, real yields are what have my attention. The 10-year real yield also down about 4 basis points. Negative 114 basis points is where we sit. We actually had a taste of negative 115 earlier on. So that is signaling some real concerns about the trajectory of economic growth. And finally, Matt, just had to point to Bitcoin. We saw 40,000 yesterday. We're back below or just above 37,000 now. All that speculation about Amazon allowing you to use Bitcoin for your online orders, that's not a thing, at least not yet.
Yeah, not yet. I think yet is the key word there. If I told you I haven't seen Evil Dead 2 yet, you would probably think that I'm going to see it at some point. Take a look at what's going on here in Europe. Red across the screen here. We're looking at losses of 0.8% in Spain, 0.9% in Germany. So some pretty decent losses, much worse than futures are doing here. And it looks like the China effect is stronger in Europe than it has been on the U.S. Yesterday, we hit another all-time high, right? So at least in risk assets, as we see those yields continue to go down. I think the most interesting thing to watch here is really Reckitt Benckiser. This is a company that makes consumer goods, and there's the only two things that you need to know. Demand is falling, and inflation continues to rise, Danny. So this is a real problem, and it's going to hit consumer goods companies around the world. It's going to be a concern for the Fed, maybe not Reckitt Benckiser, but other companies like this when we hear from them tomorrow.
Matt, don't they also make some like hand sanitizer and some kind of virus fighting type products?
Right.
I mean, I wonder if it's a good sign.
You don't need that anymore, right? Because you're fully vaccinated and you're not that concerned, so you're not using as much of the Purell or whatever they make. But I think the really interesting thing is that inflation is sticking there. So the word transitory, as we know, it's already déclassé, but they're not using it when it comes to their input costs.
I mean, it is remarkable seeing more than, 80% of S&P 500 companies mention inflation. I mean, this doesn't necessarily say transitory. It feels a little bit more sticky than that. Hand sanitizer pun not intended there. Now, let's take a look at what is ahead today. Beyond earnings, we have U.S. Secretary of State Antony Blinken, and he'll be continuing his 2-day trip to India. He'll be meeting with Prime Minister Narendra Modi there. Then at 8:30 a.m. New York time, we'll get data from the U.S. that will include both durable goods and consumer confidence. Then the IMF releases its World Economic Outlook update. That happens just a half an hour later after that U.S. data. Then at 9:30 a.m., a special investigative panel of Congress holds its first hearing of the January 6th attack on the U.S. Capitol. And later, it's the big ones. It's the earnings. You have Apple, you have Alphabet, and Microsoft all in focus. So that certainly is going to be a big factor in the way we trade today. But another big factor is what's happening in China, with Beijing's regulatory crackdown extending a steep sell-off in China tech and education stocks to a third day. A few of our guests expressed their concern.
We're on the verge of having platforms and companies that are so powerful and so influential in the political process that they're ungovernable. China has realized that this poses an existential threat to governance and law.
As you see China enter into more interest in data protection for what it considers sensitive, I think these are the types of growth in regulation we should expect.
The U.S. and China are in a tech competition, according to most U.S. policymakers, and that has meant that even on the U.S. side, there are increasing restrictions on which companies can seek U.S. dollars.
This Chinese leadership is so intent on exercising political control that they are even willing to pay something of an economic price for it.
Let's get more with our Bloomberg Chief Asia Economics Correspondent, Enda Curran, who's joining us from Hong Kong. Enda, great to have you. So what exactly is the Communist Party trying to accomplish with these various crackdowns?
Well, it's being read two ways. On the one hand, we have policy shock. You're seeing that in markets as investors are reeling by the breadth and scale of the lockdown. But on the other hand, what people are saying is, hang on a sec, the government in Beijing is merely pushing through a regulatory overhaul that was a long time coming, that has been flagged, especially in the education sector. And ultimately, it's about making education cheaper for families, and that will drive growth given China's demographics. But there's no doubt, right here, right now, it's policy shock. The conversation is about party control from Beijing. The question is, what sector is next, and will there be any spillover collateral damage?
So Beijing is trying to tighten its grip around various industries. As we know, it also has been trying to tighten its grip on Hong Kong. And a Hong Kong court today actually issued the first guilty verdict under the new security law. What can you tell us about that?
Well, this case is being very closely watched because, of course, Hong Kong is famed for the rule of law here. It's known as a safe place to live and do business. So any erosion of the courts or the independence of the legal system here will be seen as something of a major blow against Hong Kong. That's why investors are watching closely to see what kind of cases are prosecuted under the national security law and what the reasons are for that. And so far, there's a lot of concern about where the national security law may end up. It may move from the criminal courts into the commercial courts. And that's one of the big talking points about Hong Kong's future as a financial hub.
All right, Enda, thanks very much. Enda Curran there in Hong Kong talking to us about the biggest, clearly, market story around the globe over the past couple of days. Now, though, Tesla has reported better than expected second quarter results. Strong sales of its EVs delivered $1 billion in net income for the first time. Here's Tesla's CEO Elon Musk on the future of electronic vehicles.
Public sentiment towards EVs is at an inflection point. And at this point, I think almost everyone agrees that electric vehicles are the only way forward.
Let's get more on this with Craig Trudell, Bloomberg News Autos editor out of London. So $1 billion, margins of 25%, and Elon Musk doesn't really feel like showing up for calls anymore.
Yeah, I'll believe that when I see it. I feel like he's the type of guy who really can't help himself. I do think that there's a pretty good chance that we'll hear from him plenty going forward. But he had a great quarter to go out on. If this is one of his last regular appearances, you know, the margin beat was very clean. There's been a lot of criticism over time of Tesla, you know, the portion of its profit that is made off of selling regulatory credits to other automakers, those sales actually went down significantly, and the company was still able to put up a really impressive set of results. So you do see some praise for the performance of the sort of core business this past quarter.
Craig, just put this into perspective, because you've run our autos coverage in the U.S., in Asia, and now in Europe. 25% margins? Who has that?
Yeah, of course, those are gross margins. I do think that that this is a company that, it is in a position of really actually making, having some real momentum in terms of, actually going back to the big market story of the moment, the ability that they've had to bring costs down by building in China. They emphasize that the factory that they have in Shanghai is going to be their sort of, epicenter for exports going forward. What we're seeing is an ability to make, cars at lower costs. Obviously, it's hard to be much higher costs than in California, and their ability to charge, pretty substantial sums for the Model 3 and the Model Y that they make out of there. And they're shipping a lot of those over here to Europe now because they're a bit behind schedule on getting the factory built in Germany. So, this is a case while there's been a lot of concern about Tesla's position in China and whether, they're kind of getting cracked down a bit on the government, by the government themselves. They've been able to manage through that and at least at this point are in a really strong position.
All right, thank you so much for joining us. That's Bloomberg's Craig Trudell. And Tesla shares are up about 2% in early hours this morning, but I want to take a look at some other stocks moving in pre-market trading that are moving to the downside. One of them being Yum China. Basically, this is that sell-off in China coming for stocks in the U.S. that are heavily exposed there. And Yum China, with about 90% of its revenue coming from China, is falling victim to that. That stock is down about 5% in early hours. Another stock moving to the downside is Novavax, of course, the COVID-19 vaccine maker. Apparently some delays with its vaccine rollout in Australia. They won't receive their doses until 2022. That stock down about 3% as a result. And finally, as I mentioned, Bitcoin falling below that $40,000 level. Amazon maybe not allowing you yet to pay for things via the cryptocurrency. And that is weighing on some cryptocurrency-tied stocks in pre-market trading, one of them being Marathon Digital, which is down the better part of 7% before the bell, Danny.
Yeah, so maybe a little bit of buy the rumor, sell the not confirmation of rumor going on there. Definitely interesting to see who actually Amazon ends up hiring for that crypto role and what that means. Now, coming up next, we discuss the wider markets with John Bilton, JPMorgan Asset Management Head of Global Multi-Asset Strategy, as real yields continue to flirt with all-time lows and the damage from Chinese stocks emanating throughout the markets in this risk-off mood. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York, and Danny Berger is in London. Francine Lacqua is off this week. Now let's get the first word news, and the two Koreas have agreed to rebuild ties. That could lead to a possible opening for President Biden to push for a breakthrough in stalled nuclear talks. North Korea's Kim Jong-un and South Korea's Moon Jae-in have been exchanging letters. They have reopened hotlines that have been silent for a year when Kim's regime symbolically blew up a liaison office funded by South Korea. President Biden says the American combat mission in Iraq will be over by the end of the year. Still, the U.S. is expected to keep a military presence on the ground. The president met with Iraq's prime minister yesterday. American troops in Iraq have been gradually transitioning into an advisory and training role. In Tokyo, a grim new record. The number of new coronavirus cases in the Japanese capital hit a record today of more than 2,800. The surge comes as tens of thousands of visitors are in Tokyo for the Summer Olympics. Only about a quarter of Japan's population is fully vaccinated. Bloomberg has learned that Credit Suisse has tapped David Wildermuth from Goldman Sachs to become its risk chief. The shakeup comes as the Swiss lender tries to move past its multi-billion-dollar Greensill and Archegos scandals. We're told the Goldman partner will succeed Lara Warner in the coming months. She stepped down from the firm after it lost $5.5 billion from the collapse of Archegos. Coming up later on today, we'll speak with the IMF chief economist Geeta Gopinath after the release of the World Economic Outlook update. Look for that interview at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with both Matt Miller and Kailey Leinz in New York. Francine Lacqua is off this week. Now, it is a big week for big tech with Microsoft, Apple, and Alphabet earnings due out today. At the same time, Tesla has reported better than expected second quarter results. Bloomberg Intelligence analyst Matthew Bloxham joins us. So, Matthew, I feel like expectations are so high here heading into this earnings season, given what Apple, Alphabet are trading at. What does Apple have to deliver today in order to meet those expectations?
Yeah, and I guess for all of these, including Apple, it's about what they say about the future, not so much about the present. But, you know, with Apple, obviously had some new product launches in the last 3 months or so, new iPads, new iMacs. So I think people are looking for good traction with those, and that's what they say more about, you know, kind of product innovation with the iPhone 13 coming out later this year. If there's going to be any hints around evolutions beyond the kind of just regular kind of updates, and obviously what they're saying about privacy. There's been a big push from an app perspective and positioning perspective about privacy. Lots of people think they're going to get more into the ad revenue market. So what they say about that, and also obviously the services business. Apple TV Plus has been a big success in terms of bringing on subscribers. A lot of those subscribers have been getting it for free, and people are kind of now ticking into the area where they're having to pay. And can you hold on to those customers in such a competitive market when people are having to, it's not much, $4.99 a month, but when you have to start to pay, people are now making judgments about, do I keep Disney, do I keep Amazon, do I keep Netflix, do I keep Apple? So more choices for people about where they put their money.
Ted Lasso's worth it, I would say.
Agreed, Matt. Oh, yeah.
You know, a lot of people, Matt, are talking about how big Tesla is, and it's going to take a lot to move the needle, and I realize their revenue is tiny in comparison to their market cap, but Apple's a $2.5 billion company. Trillion would be no, $2.5 trillion company. I correct myself. It's huge. What does it take to move the needle there?
I mean, for all of these things, it now takes a lot. You know, we've just seen all of these stocks on a tear for the last 6 months or more. So I think, you know, it's just about that kind of forward revenue momentum. I think that particularly this quarter, margins are in focus for all of these companies. It's not just about delivering double-digit revenue growth. It's whether the profitability from a lot of these investments start to come through and pushing that more. And, you know, we did see some good news there for Tesla, for example, overnight, that actually, you know, the volumes were good, but actually the margins were better than people thought. So I think for all of these stocks, margin guidance is going to be really important.
Yeah, we'll be watching the margins for Microsoft, which also is a $2 trillion plus company. And for them, it's a lot about the cloud now. Where are we in the cloud computing competition between some of these big tech companies?
Yeah, I mean, it's cutthroat, and obviously Amazon's got a really strong position there, you know, Google as well. So they're all really pushing, and I guess the good thing for all of them is that large corporates are not slowing down on their investments in that transition to being more digital-based companies. So I think there is a lot of market opportunity there for all of them. But, you know, I think a lot of them are just trying to catch up on where Amazon has been for the past few years, and you know, margin there is also really important.
Matt, since you bring up Amazon, I'm sorry, but I feel like I have to ask about cryptocurrency in Amazon. So, you know, this rumor, perhaps they're going to start accepting Bitcoin. They say, okay, not this year. Maybe they accept it later. But what would it mean for a tech giant like Amazon to start accepting Bitcoin as a payment?
I mean, for the whole crypto space, it would be huge. I mean, it's one thing Tesla saying they're going to accept it, but obviously they don't right now, but maybe they will again. But yeah, huge. When you think about the scale of Amazon in the e-commerce business, if you can suddenly start paying with crypto, whether it's Bitcoin or anything else, I think that's just going to give a massive uplift. You know, it's a huge credibility for that whole space.
Who has the biggest ability to disappoint of the big tech companies?
Do you know, it's a good question. I don't think any of them are going to disappoint particularly. Maybe, if anything, perhaps Apple, just in terms of whether they've just got enough extra juice in the tank at this point in their cycle to kind of really surprise people. You know, typically it's more towards the back end of the year that you get, you know, excitement around the product, particularly iPhone. So perhaps, you know, they may be a little bit lackluster. I also think maybe their services business might not just grow as much as people are looking for it to.
Matt, just quickly, we only have about 30 seconds left, but we've talked a lot about these companies being pandemic winners. Who is best positioned as we emerge from the pandemic?
Well, I think you still have to look at someone like Amazon, given that, you know, that they're spread across e-commerce, which is still on a tear, and the whole kind of cloud transition. So I think they're still incredibly well positioned for that. I think you start to have to look at this interesting rivalry between Google and Apple in terms of where the digital ad market's going, and that Facebook comes into that too. So digital ads is going to be quite a transitional market for the next 2 or 3 years, I think, as you lose the cookie and Apple gets tougher on ID tracking.
All right, well, we have a lot to look forward to this week. $10 trillion worth of market cap among just 6 technology companies reporting this week.
It's so easy. I have to say, for me, at my age, it just is difficult for that kind of number to roll off my tongue to say there's a $2 trillion company.
Gotta get used to it.
Matthew Bloxham of Bloomberg Intelligence, thank you so much for joining us. Coming up next, we'll talk to John Bilton of JPMorgan Asset Management for more on earnings and the markets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Matt Miller and Kailey Leinz, both in New York. Francine Lacqua is off for this week and next. Matt, one of the really interesting things about this earnings season, I think, is getting a good view into how people are spending their savings. So far, it seems like the luxury sector is doing really well, but in LVMH's earnings, it wasn't just handbags, it was also alcohol, people going out and buying Dom. They're not just drinking it at home anymore, but they still are drinking it.
Yeah, well, I mean, I guess, I don't know how much Dom is getting sold. That's very interesting. But alcohol for sure, right? And we've seen that a lot during the pandemic, and it looks like they're going to continue to do outside. You won't know this, but Kailey, you will have noticed that New York has temporarily suspended for, I think, 2 years, the outdoor drinking open container laws. So we can actually walk around in the street drinking beers as if we were in Germany. It's pretty crazy. Definitely the savings rate has come down, so it'll be interesting to see, how much further that falls, or how much Americans remember that they need to have a nut, right? It's important in times of crisis. So I wonder how much it'll sell off.
Yeah, definitely. And I mean, it's part of the reason, right, why markets have been doing well, because those savings, they want to put it to work. I know people hate the phrase cash on the sidelines, but I mean, it does go into these markets and provide a floor. Kailey, any floor, though, to these markets today?
Not so much at this point, Danny. I will say we are off of session lows in Europe. Of course, those lows were following the close in Asia, which was really steeply negative, especially for some of those Hong Kong tech stocks. But we are off those levels now. The Stock 600 down about 0.6% at this point. Here in the U.S., after record highs reached yesterday, futures do look set for a lower open. We're down about 18 points on S&P E-minis. In the bond market, you are seeing that bid for safety showing up. We're down about 3.5 basis points on the U.S. 10-year yield, sitting at right around 1.25% ahead of that Fed decision tomorrow. But it's not really the nominal yields I'm paying attention to today. It is real yields. The 10-year real yield down about 3 basis points. Of course, that strips out inflation, and we are sitting at negative 114 basis points, right around an all-time low. So what is that telling us about the growth outlook? Also, in other assets, we do have Bitcoin under some pressure today. That is weighing on crypto-related equities in pre-market trading. You have Riot Blockchain down 5%. Coinbase by a little more than 3%. Also, of course, big tech earnings, more of them coming after the bell, including Apple, which is lower by about 0.25% at this point. Not a huge move. Tesla, of course, reported yesterday $1 billion in net income, blew it out of the water on profit and margins, and also said it may have more than greater than 50% growth in deliveries. Not really a firm number on that, Matt. Honestly, a little bit vague, but it's still giving a lift to the shares, up about 2.25% before the bell, Matt.
By the way, I don't think you can stress enough the dichotomy that we're seeing in terms of the real yield. It is at a record low, and the S&P 500 yesterday closed at a record high. So that, to me, is incredibly fascinating. One place where there doesn't look to be a floor under the market is in Chinese tech stocks. This is the Hang Seng Tech Index. As we've been talking about on its one-year birthday, you're seeing an incredible drop. This goes back to last January, but it's come down 45% since its peak, losing $750 billion. So a massive drop in these large cap Chinese stocks, these ones that are traded on the mainland. Joining us now is John Bilton, head of global multi-asset strategy at JPMorgan Asset Management. And the China story, John, has been front and center. What does it mean for other markets? I mean, so far it hasn't seemed to hit U.S. or European markets with any kind of severity.
Well, I think that's in part because it's something of a localized issue. Yeah, sure, you're going to get contagion, as we saw on the open here in Europe this morning. And, it's a reason why investors who perhaps have got a little bit more of nervousness to them may want to sort of sit on their hands over what is normally a quiet summer period. But let's make no mistakes. What you're seeing going on right now is a classic battle between earnings delivery, which is coming through strongly out of the US, strongly out of Europe, and then you're seeing a reminder of some of the regulatory issues that persist within China. And I think that this is a localized issue today. It's certainly causing some, around the globe to question some of their exposures, but by and large, it's not getting in the way of what is an absolutely thumping earnings season so far coming out of US stocks and also out of Europe.
John, in that case, what is the bond market telling us? I mean, when I was a kid, we used to call this the smart money, and it still feels so opaque when we look at these very, very negative real yields.
Well, it's telling you very simply that the Fed, the ECB, the Bank of Japan, the Bank of England, and a whole litany of global central banks are in the room buying, and we know they're going to continue to do so. What is that money? That money is not price sensitive. It's buying for policy aims, and therefore it's compressing down the real yield. And as a result, I think it's important to recognize that that's the dominant feature. We are seeing bond markets price the demand for duration for policy aims. We're not seeing it necessarily pricing perhaps quite as well as it might the growth outlook, which we continue to think is extremely good as things stand.
So do you expect that real yields could go more deeply negative here?
Well, I think what we're going to see from the Fed as they meet tomorrow, what we've seen from speakers from the Fed, continues to be a recognition that we have an inflation issue at the moment. They've talked about transients, but what we've also seen is some statements that we are a ways off of some of the policy goals. And I think that does suggest that real yields as they stand today, could they remain at this level? Could they get a little bit lower? There's certainly some plausibility there. You've got to remember, this is a quiet summer period. So the demand from the Fed for duration, demand from other central banks may be having an outsized impact. So I wouldn't rule it out. I don't think that necessarily it's something, though, that we should be overreading at this stage when all the other economic indicators and the earnings season are telling us that this economy is recovering strongly.
All right, John, well, let's keep the conversation on the Fed. We, of course, have a decision tomorrow. Does it matter, or are we all just waiting for Jackson Hole?
I don't think we're going to get the same amount of sort of fireworks, as it were, that we had around the Fed last month. I think the idea that we could get sort of further sort of hawkish surprise, probably not on the table. Certainly, we've heard Jay Powell, the Fed chair, start to row that back a little bit in some of his statements. I think a couple of things I'd look towards. We'll probably see them, probably studiously silent on further discussion around tapering. We know that there may be some acknowledgement that they've been going through the studies on this in the background, thinking about what it means economically. But I think that's something more to look for the September meeting. And I think what we'll probably see again is perhaps a statement that, we get that there's inflation in the system here and now. We're not overly concerned about it. And in fact, it's in line with our policy goals, which is to achieve full employment and to ensure the growth of the United States. And I think if we see that come through, I think it would be very consistent with what we've heard from Fed speakers over the past month or so.
John, there does seem to be this argument starting to arise out of the market that Jay Powell, by maintaining this more dovish posture, all he's doing is increasing the odds of a taper tantrum should he have to make that hawkish shift later if the data dictates that. This is an argument Matt Maley over at Miller Tabak makes, for example. What's your assessment of that?
Well, I think the time for a taper tantrum might have already passed. I mean, I think we had the absolute opposite from that. We had a taper tantrum in 2013 because no one thought the Fed would taper, and then they did. This time the market got well ahead of that. They actually started to price it in, and then the Fed said, you know what, we're going to taper, we're going to talk about doing it. And everything points to the Fed tapering during 2022. Certainly market pricing around that, is reasonably consistent. And I think that it's unlikely, as things stand, when in the moment the US still has, workers on the sidelines who are yet to come back into employment. You've still got the economy, really grappling with risks in both directions. Don't forget that they're still not through issues such as the Delta variant. I think that will stay the Fed's hand. So to my mind, at the moment, we're seeing actually a reasonably good set of guidance that's pretty much in line with what we'd expect from the Fed. And the idea that this suddenly takes the market by surprise, I think, is wide of the mark.
Okay, well, you know, if we're talking about where these markets are, John, I do just have to bring it back to this deeply negative 10-year real yield, because it is quite remarkable. What does it mean, though, from an asset allocation strategy, especially if you're a pension, you're a longer-term investor, and you're also faced with, as Matt mentioned, equity markets that are very frothy at this moment, too?
Well, I think, again, you know, it's an important point. What does a negative real yield mean for someone who's looking to take risk? It means that potentially the equity markets are well supported, carry assets should do reasonably well, absenting periodic bouts of volatility. So it's important to right-size your longer-term risk. Don't get carried away here. You know, this is an economy that's moved through early cycle very quickly. It's now in mid-cycle with few signs of monetary policy tightening. That's a good environment for risk, but it's not one where you want to be sort of maximum risk on. It's one where you're looking for, you know, good delivery through on earnings. You're looking for a little bit of quality of earnings and decent momentum out of markets. What does it mean if you're looking at bonds, though? Well, of course, it rather depends what you're trying to do with them. If you're looking for a return from bonds, you know, the bad news is it's either going to be low or it could indeed be negative if and when rates start to rise. But if you're managing liabilities or de-risking, then of course bonds still have merit, because on the other side of the ledger, there may be risks that you can manage just as effectively with duration. So the price sensitivity of buyers of bonds is not necessarily as high as perhaps the real yield may imply. And there will still be a healthy bid for bonds, even outside of the demand from central banks, in our view.
All right, John Bilton, head of global multi-asset strategy at JPMorgan Asset Management. Thank you so much for your time and insight today. And coming up, infrastructure talks suffering yet another setback as Congress runs up against that August recess. We'll have more on exactly where those negotiations stand next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, GE Chairman and Chief Executive Officer Larry Culp joins at 12 p.m. Eastern. Don't miss it. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Danny Berger is in London. Francine Lacqua is off this week. Well, Danny, Matt, it is Tuesday morning, and still we do not have a finalized deal on that $579 billion bipartisan infrastructure plan, and Wall Street is stepping up the pressure on Congress over that package. The heads of BlackRock, Blackstone Group, and Morgan Stanley are all among the CEOs who wrote to congressional leaders, urging them to, quote, seize the moment and act quickly to pass this bipartisan initiative. Joining us now for the latest is Joe Matthew, Bloomberg Washington correspondent and host of Bloomberg Sound On. So, Joe, the street's pushing for it. Many are pushing for it, including President Biden. When are we actually going to see this thing finalized?
Well, that's a great question. Hearing a lot of darkest before dawn references here this morning in Washington, where the sun has yet to rise. They did meet last night, negotiators, 10, of course, Democrats and Republicans combined, and those 10 people really may be the only ones who actually know what's going on here inside the Beltway. They've been playing this very close to the vest. But indeed, you point out, how often do you see Wall Street banks, the U.S. Chamber of Commerce, and organized labor all lobbying for the same bill? That's where we are this morning. And there is some optimism when you hear from the negotiators themselves. To be clear, we could get a deal at any time, but we're obviously not there yet, and the sticking points remain largely the same.
Is it possible, I mean, as the Democrats threaten to take what they want anyway with the reconciliation, is it possible that the Republicans are less inclined to make a compromise with them?
You're definitely getting somewhere here, Matt, and I would point you even further to the House. You know, even if we get a deal here in the Senate, they have to go through this whole thing again in the House, where both Democrats and Republicans have really shifted their tone over the last couple of days. Democrats saying, in some cases, I spoke with Congressman John Garamendi last night from California, a Democrat on the Infrastructure Committee. He says this bill is yesterday's infrastructure, and he's looking forward to more of that soft infrastructure, the sort of human economy that they're talking about with reconciliation. Republicans, on the other hand, the ranking member of Ways and Means told us on Sound On just a couple of days ago, Republicans will not vote for a bill that hikes taxes or is tied to reconciliation. So, guys, even if we get through this bipartisan deal in the Senate, we've got more obstacles coming in the House.
So, Joe, certainly another contentious topic is vaccines and vaccine mandates. We've seen some action coming out of states. You have California requiring all state workers to show proof of vaccine, New York Times reporting that, and that the Veterans Affairs is also going to require healthcare workers to get vaccinated as well. Does this at some point move from a state level onto a federal stage? Could the federal government have to act and itself put in some of these vaccine mandates?
In terms of vaccines, maybe not. We're talking about masks still, though, Danny. Will there be a mask mandate? It keeps coming up with the White House, and they've been very clear to say that Joe Biden, the president, will not be the one to make that decision. They're going to take their advice from the CDC on this. But they are in a tough spot here, considering the fact that taking your mask off was one of the few obvious rewards beyond your own health to getting vaccinated. So if we're in a world here in which the White House is urging people to get vaccinated and keep your mask on, there are worries this morning that that could slow the vaccination rate or, in fact, lower the vaccination rate in states in the South that we've seen here. So the White House is walking a pretty delicate line on this one.
Right. It's interesting, Joe. Initially, when the CDC said, hey, you can take your mask off and if you're vaccinated, that was supposed to entice people to get the vaccine. And when you tell even vaccinated people to put their mask back on, maybe it removes some of the incentive there. I want to quickly go back to budget-related things on Capitol Hill because it's July 27th, which means the debt ceiling suspension expires in 4 days. Where do we stand on a fix for that?
Nowhere. This is another big part of this. In fact, it's been suggested, as Mitch McConnell says, I'm not going near the debt ceiling, and he's telling Republican members to stay away from this. Democrats may actually end up putting this in the reconciliation bill. But we've got many steps to go through before that. They have to start the budget process to allow for reconciliation, and we're still not sure what's going to be left out of any bipartisan deal that may be struck. So we've got a lot of plates spinning in the air this morning in Washington, and they may be spinning by the end of the day as well.
All right, well, we'll keep tuned in to the Sound On podcast for more from you. Thanks, Joe, for joining us this morning. Joe Matthew there from Bloomberg. Coming up next, part of our interview with Nobel laureate and NYU business economics professor Paul Romer. This is Bloomberg.
We're on the verge of having platforms and companies that are so powerful and so influential in the political process that they're ungovernable. China has realized that this poses an existential threat to governance and law, and they've decided they have to stop it. We haven't gotten there yet in the United States, and I hope we get there soon.
That was Paul Romer, NYU professor and Nobel laureate, discussing China's regulatory crackdown on Bloomberg Surveillance yesterday, and how lucky we are to have co-anchor of Bloomberg Surveillance, Tom Keene, joining us now. Tom, I just have one question for you. Can you make sense of a 10-year real yield at negative 114 basis points?
It's an historic moment, and the way you do this, Kailey, the way the pros do it is they look at three parts. They look at the nominal yield, the regular 10-year yield. They look at the inflation expectation, you subtract that, and that gives you the inflation-adjusted yield of the so-called residual. You can look at just the real yield, which was now on 10-year negative 1.14. Let's look at the chart while we chat this up. Kailey, what's so important here is not only the lower nominal yields because of this worry, that worry, but also the rising inflation expectations. Larry Summers has hit the ball out of the park on this with a seminal article off of his research on secular stagnation, and he goes back to Keynes' 1936 and calls it magneto trouble. Matt Miller is the only one on the planet watching this that knows what a magneto is, but Matt Miller, it's magneto trouble.
Yeah, well, absolutely. I wonder about the renminbi, Tom. One of the marks of the pandemic has been the strengthening, and I do this because it's dollar renminbi. The strengthening of the renminbi. Now we're starting to see a little weakness with the crash of Chinese stocks. Is that important?
Yeah, I think it's important, and it is today. It is this Tuesday. Monday, we really saw an equity adjustment in China, and today it's far more correlated, folks, with renminbi. I'm going to do the Miller thing. Stronger, weaker renminbi as compared to the dollar, and that gets you out, if my eyes don't fail me, 6.50, rounded up, Kailey. That's weaker yuan to the dollar.
It is indeed. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And for our listeners on London DAB Digital Radio, they're just moving their hands up and down. That's what they're talking about.
Oh, thank you.
So now let's take a look at what else we are watching. And Matt, I know you can't get enough of what Tom and I were just talking about, real yields.
Yeah, I mean, I just wonder how much further they're going to fall. Is this the only direction real yields can move right now? We continue to see down, 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 or does it turn around? I'm really going to be watching surveillance for that, because I know they're going to talk to someone who thinks it might recover, so I'm tuning in.
Yeah, we definitely all will be. I mean, those stagflation fears very clear in the market, Matt. And I have to say, what I'm watching might sound like it doesn't apply to this, but it definitely does. And that's the UK virus case count. So yesterday, it notched its 6th consecutive decline. And this is the real test here. People pointed to the UK as this experiment. How much do we care about these cases versus hospitalizations? If we don't focus on the case count, maybe they will continue to drop. Maybe we've reached herd immunity. That's a word that's kind of become a dirty word in the UK after an earlier attempt to kind of put that out there. However, if it falls again, Kailey, I think it will say a lot again about this sort of grand experiment of reopening when case counts are high.
By the way, it keeps falling since Freedom Day, right? After Freedom Day, it just drops. And I think really the right question is, how much does the case count matter? If you're not going to the hospital, certainly not dying from this, if you're vaccinated, then, I mean, is it worse than a bad hangover?
Or a cold.
And 70% of people in Europe vaccinated now. That just coming out today.
Yeah, well, we're still trying to get more people vaccinated here in the U.S. That rollout has certainly stalled. So it'll be interesting to see if the Biden administration takes any real cues from the U.K. and also if they're going to allow people in the U.K. to start coming to the U.S. or anywhere in Europe for that matter, because they still haven't made a decision on that part of the travel ban. Something else I'm watching today, of course, big tech earnings. We're going to get about $6 trillion in market cap reporting just after the bell today, coming from Apple, Alphabet, and Microsoft. So the direction these stocks move on their results could very well move the broader market as well. For Apple, all about those iPhone sales. For Alphabet, it's going to be about that recovery in digital ad demand. And for Microsoft, we're watching growth in cloud computing as well as the margin forecast. So it's going to be a lot to digest, Matt, after 4 p.m. Eastern time today. $6 trillion in market cap.
Exactly. I mean, Dave Wilson was telling me this week we're going to have half of the S&P 500 market cap reporting, but 6 stocks represent about 25%, I think 24% of the S&P market caps. They're just absolutely huge.
And the S&P has had pretty poor breath even as we're getting to new highs. So if you take out the stalwarts of that rally, which of course is big tech, that could be not so great for where we go from here, Kailey.
Yeah, that cyclical leadership certainly isn't taking place. It's all about the growth names, at least for now. We will see if that changes once we get the results from some of these giants. Well, that's going to wrap it up for us here on Early Edition. But don't worry, there is more Bloomberg Surveillance ahead. Chris Verone of Strategis is among the guests, joining Tom, John, and Lisa. This is Bloomberg.